gave up managing billions to become a better investor. Episode 9, The Daily Routine. Hello. I spent the last 8 podcasts talking about the importance of macroeconomic issues, microeconomic research, fundamental analysis, numbers, perspectives based on sentiment, even occasionally the odd mention of matters concerning technical factors. But essentially, you should be spending circa 25% of your time on macroeconomic and global issues sort of thoughts, and 75% of your time on thinking about companies and sectors and that kind of bottom-up research-driven view of what a company is doing and whether it's cheap or expensive or attractive or not. Pulling it all together, throwing in some thoughts about sentiment and other relevant matters, and then going for it. And of course, that's the key for all investment work. You ultimately have to go for something. It doesn't matter if you're wrong. As we've talked about before, everyone is wrong at some point. It's not that people come up being a fabulous investor immediately. And I don't think, to be honest, anyone ever is a fabulous investor. You are going to always get things wrong. The key is to go for it, to take a risk and say, right, this is something I believe. This is something I believe is cheap or expensive or whatever your view wants to be or needs to be. And you make a decision and go for it. That's the way you become ultimately a better investor. Not being afraid enough to say, in 10% lower, maybe I'll buy the share, or maybe next week I'll have a think about it. The key is to be able to say, I'm going to go for it. I've done my research. I like what I see, and I'm just going to buy it or sell it or whatever the decision has to be. The thing is, though, where do you start? Where does the whole investment game kind of start? You may have this, I want to be an investor. I've learned some sort of basic ideas about the sort of things to look for, the fact that you've got to be aware of the macro backdrop out there, the fact that you've got to do some investment research work, sentiment is influential. But where do I start? Where do I find an idea? The reality is you live amongst them. Something that you think is interesting, and that's the key with all investments, something that you think is worth looking at. There's no point in, well, I guess some people do just copy other people and say, because person X said this was a great idea, then this is something I'm going to go for. That's absolutely fine. If you want to do that, that's absolutely fine. But honestly, it's just a little bit better than just flicking a coin and saying whether it's going to be heads or tails. Because reality is, just making investment choices on other people's opinions and views and related, honestly, ultimately, you may as well send your money out for somebody else to invest full time. If you want to be an investor yourself, then you've got to get your hands dirty, as they say. You've got to actually do your own research work. And by of course, you can discuss with other people, read influential and important stuff, get different views to kind of see whether you're completely mad or kind of making some sense. That's absolutely fine. But ultimately, you've got to do stuff yourself, and you've got to write it down, and you've got to keep on looking and keep on thinking about it and accepting that sometimes you're wrong, but often sometimes you're saying, well, actually, this is a great idea. I still think it's cheap. I'm going to buy some more shares, and doing something which maybe the market is not generally agreeing with at this moment in time. And as I've discussed in a number of podcasts, the key for me is if you know more than 90% of the market and you've come across a good idea, then believe me, you do have a chance for it to work. And obviously you have to think about the macro backdrop and sentiment and related. But if you've done your research and thought about it, then that's your best chance. In terms of the daily routine, what do I do? What do I sort of think is important? Because it's easy to say, right, you should spend 25% of your time thinking about macro, 75% about sector and company issues, bring it all together, and that's your day. When, obviously that isn't kind of how it really works on a day-to-day basis. You've got other obligations. Sometimes you've got lots of free time. Sometimes you've got very little free time, etc., etc. Reality is, though, I think you need to be focused on a couple of important underlying insights. From a macro perspective, we're so lucky in today's world. We get so much free information or available information to us. And yes, maybe that is on the computer, websites, etc., newspapers, TV, all of it is potentially important. Some is certainly better than others, but at least it's out there. And I think my guess is, and I've probably said this before, I reckon the big problem in today's world is that there's too much information out there. But the key of the good investor is to work out what's interesting and useful and what's, just noise, basically, or just chit chat, those comments from a friend down the pub or whatever the equivalent might be. So a bit of macro work each day is important, and macro can take many shapes and forms. As I said, it can be all those previously mentioned areas. It can be more formal things such as the views of central banks, comments by economic thinkers and entities. There are many different sources, again, many of which appear in the newspapers or online and on websites and related. The key is to actually, I would say, do your own research in the sense that look at what people have written specifically rather than relying on the best thoughts of somebody who's perhaps a journalist or is making comments on a random website. Go back to the original source and say, what's it saying there? What's important about it? Is this view interesting? Could there be some different aspects and indications from it that could become super useful for some general investment thinking or awareness of how the world is working out there? Because as we know, the role of macro really is to give you a feel for the backdrop out there, whether there's going to be economic growth, whether inflation is an issue or not, whether we have a big problem with rising food prices or the availability of people to work in a business. All of this knowledge is super useful when you're actually looking at a company or a sector and kind of thinking from a bottom-up perspective whether a company is interesting, cheap, expensive, or whatever. What I find is when I make investment choices, I'm drawing 25% of my thoughts from that macro backdrop and 75% from the sort of company sector backdrop, and you bring it all together and that brings you that overall decision. And that's why adding a little bit of sentiment thoughts or whether people have kind of discovered something or not becomes apparent, becomes that challenge of being one of those first 10% of investors to find something. It doesn't become as difficult as you think. And I know when that was said to me for the first time, it was like, wow, how on earth can I know more than 90% of the market? People at that point who were way more experienced than me, etc., etc. But reality is, it's not as difficult as you think. And that aspect, that indication brings me to the second point, which is theoretically, anything is potentially investable. Okay, let's talk about equities. So obviously there's only so many equities in the world, and obviously maybe you want to just be a UK investor or a US investor or an Asian investor. Absolutely fine. But nevertheless, you're still going to have hundreds of potential companies to look at, maybe even thousands. So there's plenty of potential choices out there. The key is actually not to worry too much about knowing a bit about everything. You don't need to know about every single FTSE 100 company. The important thing is, though, to try to work out what is important from a macro perspective and from a sector company perspective for the individual company that you're looking at, and whether actually that company is saying something useful, interesting, which does indicate that through some of those analytical criteria and valuation criteria I've talked about before, the EV/EBIT multiple, the free cash flow insight, what's happening with revenue, what's happening with the business prospectively, the expectations for the next year or two, what it means for valuation, what perhaps company is saying in terms of its comments at the last set of numbers and related. When you put all of that together, anything is potentially investable, but you've just got to go through all those bits of research work and related to allow you to come to the ultimate conclusion. And I guess that's the wonderful thing about investment. As I've said before in a previous podcast, believe me, the hardest point is making that decision and actually doing something. And you have to accept that you don't know perhaps everything about a company when you start. And frankly, I'd worry if people waited until they knew everything about it, because you could be just researching forever. I think I've talked before about the guy I met when I was somewhat younger who had spent 6 months looking at a company only to conclude it was a hold. I mean, how terrible, how boring. This is why I've said in one of my earlier podcasts that the key is really to start to come up with some ideas, to come up with some thoughts. And it doesn't need to take absolutely ages, but you do need to still do some various important analytical and valuation pieces of work. Back to what Mr. X said to me, those kind of 5 key bullet points and 2 charts. It's probably a little bit more sophisticated in today's world, but not that much more. It doesn't need to be, pages and pages and pages and pages of research, but you do need to write something down, and you do need to make an effort on multiple sort of perspectives. And the beautiful thing of writing something down, or I guess in today's world I should really say typing it into a spreadsheet or something like that, and another piece of written work on a computer, is that when they next come up with their next set of numbers, when you look at those numbers, and that is super important, making sure that you keep in touch with when a company is reporting, when they're saying something new and different. That's what you've got to do. You've got to say, okay, has my view changed? Do I need to evolve my positioning or not? Am I still correct? Is it still a cheap stock? Is it now expensive? Has something changed for me? Ditto the macro insight, where obviously things happen all the time, every day. Oh my goodness, because the central bank says something, or because politicians are doing something different with global trade or whatever. How is that impacting? If we have a problem with a geopolitical issue, what does that mean? Does that have a big impact? Of course, there are a myriad of potential implications of all of this. And as always, it's easy to worry too much and not really think about it. But as I say, you need to bring this all together and say, what do I believe in? Write down some brief notes on that and keep on updating it, keep on reading it, keep on thinking about it. And believe me, your potential to be a good, successful investor, somebody who can do better than the average person out there, or the average fund out there, or the other alternatives to put money into investments, it is apparent. But it also makes the investment game kind of interesting too, insightful. You feel as if at least you're trying. And even though, as I say, you might get it wrong, and believe me, I get plenty of stuff wrong, despite doing lots of research work and thoughts and valuation criteria, stuff happens, something changes, and you learn from it. That's absolutely fine, because believe me, as an investor, you've got to accept that you'll make mistakes. But over time, through hard work, effort, and everything else, remember that stat I quoted, or a great sort of quote I used to make, I remember a number of years ago, investment life is 90% perspiration and 10% inspiration. That is so correct. And as long as you keep that in the middle of your brain and say, that's how I'm going to keep on working, believe me, you'll be all right. And that's why I say to people, even though you may not have huge experience, or maybe if you do have quite a lot of experience, there's always scope to improve, always scope to find something interesting. Now, so we've established that theoretically any company, if we're talking about equities, I guess we could talk about bonds in a similar format, anything is potentially investable. And you can find out whether you think it's interesting or not, and hence make an investment or not as you conclude. What do you do then, other than keeping in touch with their website, making sure that when their next corporate results are out, make sure that you listen to that podcast from them, or making sure you're keeping on trying to learn more about the business or learn about new details and information out there. But what else should you be doing? Well, for me, there's an important weekly point for every investor. And I know this sounds a bit boring, but believe me, investment needs to be a little bit boring. It can't just be flipping a coin and saying, I really like this, but nor can it be loads of research on one company and convincing yourself that it's fantastic, but all you're doing is knowing more and more about less and less in essence. The other important thing to do is to make sure you do a little bit of time. And I would say once a week. For me, it's always at the weekend when markets are closed and I've got a little bit of free time to kind of do this work. I focus on, okay, so what does my portfolio look like? What are the position sizes? What percentage that? What what sector split do I have? Some people even say, what country split do I have? Which is a very sort of big thing that lots of funds do, who become obsessed with the fact, well, we have 25% in UK stocks and only 15% in US stocks and 5% in Asia and whatever, without realizing that many of those companies, of course, are wholly international themselves, which makes it super complex. For me, I tend to look at it as individual stocks and make sure, in my opinion at least, that you have no individual stock at more than 10% of your portfolio. Now, there's a lot of debate about this, and I do appreciate people with smaller portfolios are probably thinking, wow, I'm not sure if I have enough money to really invest in 10 different stocks. And fair dues, maybe that is the case, or you feel that's a tricky thing. But generally, I'd say if you had more than a £10,000 in sterling terms portfolio, you can invest £1,000 in 10 different companies and not feel as if you're doing yourself sort of disservice by not having a decent investment or something that you can regard as important. And obviously, there's many online investments now where you can put £1.50 into a stock, and it doesn't matter what the amount is, as long as you're learning and hopefully perhaps in your wider life earning a little bit more money over time to build your investment portfolio. Obviously that £1.50 or £10 or even £1,000 for an individual position ultimately gets a bit bigger. The key is, though, I think, to make sure you don't put more than 10% in any individual stock. And actually, my advice would be, and I've talked before about when there's volatility in share prices, perhaps you've made an initial investment, it hasn't worked. Rather than do this whole, if something falls 10% or 20%, I'm out, I think you need to reappraise and say, do I double or quit? That's a much more important insight for me than just saying, right, if I'm at a 10% loss or a 20% loss or whatever stat it is, I'm out of there. I'd say, look at it and say, do I double or quit? Because believe me, there can be a myriad of reasons why a stock moves around. Some of it macro, some of it just a bit of bad luck, some of it because obviously fundamentally things are bad at a company. But ultimately, you've got to go there and look yourself and say, right, with my updated macro, micro, sector, sentiment and related issues, what do I really think today? And as I said, really make sure that you keep in touch with companies' reporting schedules. That is so important. I know it sounds boring, but please write down in your future diary, XYZ company has got their next set of numbers out on the 17th of May or whatever the date may be. And you should know that. And of course, you can access stock market information. There's, for most major markets now, there are ways you can access today's data. Today's news is talking about this company and that company. You can follow the tickers and you find out if they've come up with a new announcement, etc., etc. Even have ways where it sends it to your personal email address and related. And that's a very smart thing to do and something I do myself. But I was talking a couple of minutes ago before I got waylaid by overexcitement about the importance of research and related. I said, what do I do each week? We've talked a little bit too much about daily stuff and thinking about what research you should do and related. What boringly do I do each week? I look at what my portfolio is looking like today or at the end of the week. What's the split? And not just from a company perspective, but also a sector perspective. Personally, I don't put more than 5% in any company from the get-go, and I don't have more than 10% in any holding at any one time. Even if, let's say, a stock, I've doubled the position because I really love it. I think it's great. I'm excited by the company. If it goes above 10% of my allocation, then I start to top slice, because the thing is, you've got to be a little bit careful when something goes above 10% of your portfolio. Now, occasionally that happens through good luck, where suddenly some great news comes out and a company goes from a 7-8% position, it goes up suddenly to 10-12% because it's gone up and nothing else has. Absolutely fine. You can't be so stiff as to say if it goes to 10.1%, I've got to be immediately selling it. But you've just got to always say, okay, is this just a one-off? Is there perhaps there was a takeover bid or a new bit of news or whatever? But often I find if a share has gone up by a significant proportional magnitude, then something's happened. There's probably been some news flow, something important. You hopefully appraise that news flow, how to think about it, maybe a new set of numbers that have said some really great things about future profitability scope. And you can say, okay, that's fantastic. What is my fair value? How far do I go? And I know some people say, well, you should run your winners and cut your losers. And there's some good thoughts in that. But I observe if you have that sort of 10-12% position and you're saying, I'm still really optimistic about this one, and you're saying, well, I'm hoping it's going to keep on growing. It could be 20% of my portfolio, 40, 50%. Fine. Fantastic. Very clever if that happens and you've done that. But I've seen too many other examples where that kind of initially successful, maybe quite big a material position does the complete opposite. And something else happens, something you hadn't, you'd fallen in love with the share. You thought it was brilliant. Everything was going to be fantastic. And that 10, 12% absolutely comes back down to 5-6%. And of course, because it's a big part of your portfolio, it has a big part on your overall performance. And it, of course, psychologically is very, very tough for you. So believe me, it's always best not to have sustainably 10% plus in an individual position. If you're there because of some good luck, brilliant performance or whatever, fantastic. But look at that point to top slice to sort of say, fantastic, made a great return, take a little bit of money out, keep some shares if you still believe in it, but top slice. And that is a smart thing to do. Ditto at the bottom end, if on those super small positions, always look at all positions that you have. Ignore the fact whether it's a 0.3% position because it's been a shocker. I originally had 3% of my fund in that. It's now 0.3%. I'm just not going to bother with it anymore. Keep on looking. Maybe something's happened. Maybe the terrible company's become an interesting one again, just because the share price has come down, things have changed, new management, stuff's occurring in the macro world, whatever it might be. And then maybe you double, triple your position, and you never know. Maybe you can make your money back to some extent. But you've got to keep on thinking about them. This is the boring thing about doing research, making sure you're aware of news flow, bit of macro, bit of micro. Keep on thinking, keep on working. I know it's a busy, deep game, this investment world. But believe me, hard work pays off. 90% perspiration, 10% inspiration. If that's all you remember from this, that's a good thing to remember. Okay, talk about sectors. Sectors, believe me, are important. And I say that again from a perspective of you don't want to bias your portfolio too much. We've talked already about how I'm not a big fan of having more than 10% in an individual stock for a long period of time. You know, a few weeks because something's done remarkably well, great. But if it's a fundamental position and you're saying I'm going to always have 15% in this, I'm going to kind of worry a bit about that. What about sectors? What are sectors? How do they split? How does it go on? Well, I reckon there are 10 key sectors out there, and many brokers have their own list, and I've seen a few of them, and some are better than others. There's obviously some pretty obvious sectors out there, be it utilities, be it technology, be it pharmaceuticals, and related. But I kind of think that two things. I've actually done an upgraded personal sector list, and I'll go through that in a second. Again, it's only 10 sectors, but I think it's a bit more realistic for today's world, or at least how I see it. As an aside, I don't really focus too much on global matters per se. I know that many people, perhaps listening to this from Britain or America, are saying, well, it's not really an issue for me because all I buy is UK shares or US shares or related. That's absolutely fine. But remember, where a company is listed and where it's actually trading in terms of its day-to-day underlying business life, it can be completely different. Let's use the UK as an example. The UK market is so non-UK. Okay, there's 30% of it that's very UK-centered, but the other 70%, particularly in big FTSE 100 companies, are truly global. And that's true in Europe, that's true to a good extent in Asia, and even for certain US companies as well. You know, they're inherently international plays, whilst a listing element is important, of course. If what's happening re taxation in a country or something like that, believe me, I would say minimize your thoughts on country matters per se. Think a bit more about sector issues, because sector issues are much more relevant for biases of portfolios. Now, I know that all shares kind of, sort of an element of it does the same thing. Okay, if markets are going up, shares are going up. And there's an element of truth about that, but only an element of it. Believe me, thinking about the right sector and sector backdrop issues is important, and something which relates very nicely to your macro work, but also your company work, company-specific work as well. Anyway, 10 sectors. I promised you that. So I've got 10 sectors on my list, and I'll share them with you now. The first is in the sort of what I call the sort of materials, commodity, stroke agriculture phase grouping. Now, you often see that investment companies talk about basic minerals or basic materials as one sector, and energy or gas companies related as another. I actually combine the whole lot. That sort of materials, commodities, and don't forget agriculture as well. That to me is one combined sector. Then, of course, we have two different consumer sectors. Now, normally, most in sort of investment institutions will talk about non-cyclical consumer goods and cyclical consumer groups, which sounds a bit messy, to be honest, doesn't it? You know, what's cyclical, what's non-cyclical? Surely everything is cyclical at a certain level. Well, that's kind of true, to be honest. The way I think about it is it's one should be viewed as consumer goods, and one should be viewed as what I actually call, rather boringly, retail stroke travel. And that is because it's trying to sort of break in the notion that some consumer goods businesses, i.e. things where you buy as something in your shopping list bill, or because it's a medicine, because it's a biscuit, because it's something like that. It's something which is a little bit centered on your life as a consumer. You choose to buy it for a particular reason. Some of which because it's cyclical, or some of it's because it's non-cyclical inherently. So I tend to do it that way. I think about it much more from a consumer full-on perspective. And then whilst retail and sort of related travel issues, that is a lot more discretionary. And I know that kind of this is where the cyclicality element comes in, but I kind of prefer to kind of split it between stuff that is sort of food and related centered, much more on a consumer basis. That's an important regular part of your consumption, and stuff which is a little bit more kind of retail, sort of centered on travel, on retail and personal choice kind of consumption. So that's the way I kind of split the consumer sector. Obviously, industrial matters are important too, but industrial issues is another sector. Often, you often see with institutions, they talk about, industrial sector stocks. I have industrial stroke building stocks, or because building stocks, I kind of feel they're a tough one to kind of think about in any other way, really, because often they end up in the consumer sectors or cyclical consumer sectors or something, and that kind of seems a bit bonkers to me, because the building and related industry is much more closer to the industrial sector inherently, in my opinion. So that's where I look at that. Obviously, financials remains unchanged. Healthcare, pharmaceuticals, combined sector remains unchanged. Technology, obviously, core and important sector, that remains unchanged. Utility is the same. Not as important as it used to be, but believe me, still is out there. I know a lot of institutions talk about is the importance of real estate, and I haven't mentioned that yet. Property, real estate, and related. And for me, actually, I keep that a bit aside. As I've probably said already, the most important thing for property, in my opinion, is to buy your own house. People who think that it's important to buy 5 different houses or loads of property shares, stuff like that, that's a little bit more specialist. I tend to actually stick it into my very final and 10th sector, which I actually call a sort of multi sector. A multi-sector is first, yes, it's anything to do with property or real estate or related, but it's also to do with those companies that are not easy to sort of say what they are, maybe because they're complex companies themselves in a multiple of different sectors. I'll give you an example. For example, think about something like Rolls-Royce. Now, Rolls-Royce, it could be a defense company, and defense, I guess, would be an industrial name, okay, or it could be a company that helps supply engines to the airline and related sectors. Well, there's a big travel element there. So what do you put it in? Do you put it in my sort of retail travel sector, or do you put it in my industrial and building sector? It's tricky. As something like a Rolls-Royce, I would stick actually into a multi-sector, because actually it's got two important sectors, actually a little bit more, I'd say. But because it's multi, I kind of prefer to have that in a separate sector. And believe me, there are quite a few companies out there which are truly multi-names. They inherently are kind of 40, 50, 60% one way and consequently 40, 50, 60% another. And believe me, they are the ones which are tough. Often they're the ones not particularly well followed because either the wrong analyst is looking at them or they've got two sets of analysts looking at them, maybe with different opinions. And of course, Rolls-Royce being a good example. Think about the last couple of years as I speak here in 2023. That share has been very volatile for different reasons. Obviously, the defence side has done quite well recently, but it's only been until more recently that the travel side has done better. Hence why the share took some time to recover versus, let's say, the more purer defence plays, the BAE Systems, for example, which I would view as a more pure industrial type company, which obviously has done a lot better earlier, quicker than something like a Rolls-Royce because it didn't have so much travel and related sector focus. By contrast, at times when the travel sector has been very strong, BAE Systems was relatively dull, defence was relatively unloved as per certain other broader industrial spaces. But by contrast, the travel side was exciting for Rolls-Royce and its shares were doing fantastically, let alone what airlines were doing and related. Anyway, so far I've come to 9 sectors. This sort of materials, commodities, agricultural sector number 1, sector 2, consumer goods, sector 3, retail stroke travel, the sort of more cyclical consumer side. Number 5, financials. Number 6, pharmaceuticals. Number 7, technology. Number 8, utilities. And I talked about number 10 already, which is multi, with sort of the property stuff chucked in there as well, because I can't think of anywhere else to put it. What's my number 9? What have I missed? What isn't in apparently the institutional space, but somehow I've found something interesting to talk about? Well, I actually call it an area which I think has become kind of a bit more relevant in today's world. And I call it actually facilitation. And facilitation is something where a company is doing something because it's perhaps assisting maybe an industrial company deliver something to consumers or related. And believe me, there are plenty of companies like that. One of my favorites at the moment is DCC in the London market. And again, when I look at the company, I think to myself, hang on, where do I put this name? And I observed that many of those companies are very tricky to try to work out where you should put them, how analysts should look at them and related. And believe me, is it an important part of today's world where companies have certain specific roles and help facilitate an industrial company to send something to consumers or an agricultural company to send something to a supermarket or related? Yes, of course, there are times when perhaps an agricultural company will be doing that itself, or a supermarket, one of the sort of the consumer goods related areas, is itself sorting out its facilitation, its delivery of its goods to its stores, etc. But increasingly, you're seeing that part of the world being outsourced, and of course, this is actually, I think, very true in much more in today's world than it would have been 20, 30, 40 years ago. So hence why names such as DCC are pretty good examples of that. And believe me, when I look at the world, I see that becoming an important part of the sector space, or at least a space which people should really start thinking about a bit more. Anyway, just my personal view. Okay, so I've got 10 sectors. Why have I got 10 sectors? What does it mean? What you should be holding in them? Well, of course, I'm not going to say to you should be having 10% in all sectors. That would be complete madness. Ultimately, you should be driven by your thoughts from a macro perspective and obviously from a company's and to some extent sector insight perspective. What I would say, though, is I mentioned on individual companies, you shouldn't have more than 10% in any individual one company on a sustained basis. On a sector view, you can be a bit more lenient. You can have a bigger proportion in because, you may come across 2 or 3 great ideas in one particular sector, but you want to just mind your biases again a little bit because you don't want to have too much. If you have everything in technology, whilst you might be absolutely correct, it's the smart thing to do. And clearly, if you'd have done that 10, 12 years ago, that would have been a smart thing to do. But it may not always be like that. And as people have seen more recently with tech or financials or any sector you could mention, that wasn't a smart thing. You get volatility in certain sectors for very real reasons. So don't put all your bets in one basket. What I would say re a sector is 25% max in any sector. There isn't a minimum. If you don't fancy having any financials or technology or industrials, fine. If that's not your bag, if it's driven by your research preference in other areas, absolutely good. Just don't have too much bias in your portfolio. So I would say if you've got more than 25% in any sector, once you've sort of added up your all your individual companies, you've got your percentage of your portfolio that's in them. When you've added that up for each of your 10 sectors, believe me, if it gets above 25%, think carefully. And I would never really, okay, if it's 25.1%, you don't need to be so, oh my goodness, I've got to sell something here. But it makes you think. And that's the whole point. And this is what I do each week. Sounds a bit boring, but obviously through online, probably most people hold their portfolio online nowadays. They can access it through a website or something like that. You can get the information. What is your portfolio worth? What percentage do you own in particular stocks? What percentage do you own in particular sectors? Work it out. I know it's a bit boring, but believe me, if you want to be a good investor, or at least have fun doing investing, this is what you've got to do. A bit of hard work, a bit of graft, a bit of keeping this sort of information there. Believe me, it does help and it does matter. And it does ultimately give you better insight. At least you're not going to be saying, oh my goodness, why on earth did I invest in that? I'm so stupid. What was I thinking about? Because if you're keeping all the notes and the comments and related on that, then at least you've got a role and a rationale for it. And you could reappraise where you went wrong or perhaps where you were fantastically right. But most importantly, when a company comes up with its next set of numbers, and believe me, as we've talked about many times on these podcasts already, the key is the future. What's gone is gone. You can learn something from the past. Of course you can. And it's the same with investments. But ultimately, when you buy a company today, you're ultimately investing for tomorrow or next year or 2 years or whatever it might be. And that's important. So you must always look forward, always make sure you know when a company is reporting, when it's going to next say something to the markets, or have a capability to know if they say something in surprise to the markets. And I know it again sounds boring, but each day you should be saying, okay, even though maybe you're doing another job and you've only got a bit of time at the end of the day to look at it, fine, but do it. When that new information comes up, a new set of numbers, a new comment by the company or some other macro source or whatever, just note it down if it's important, or read it up, or whatever you need to do. Just keep on taking a few notes, keep on being aware of what their timetable is going to be. So you're saying, okay, I must remember this company's got some numbers out tomorrow. I'm going to have a look out for it, because believe me, if you're just investing in something and then, oh my goodness, it reports next week, you may as well just wait for the numbers and react to them. And that's another important thing to know. Sometimes, and I would say, certainly when I look across most global investments, a little bit less than the UK, you get that quarterly earnings season, which I actually love. Okay, it keeps you busy, but I do love. The most important time to be investing in a company is actually typically after earnings season, after they've reported their earnings. And it may be on the same day that they report it, but you've got that new pure information on a company. And that's where it becomes the most helpful and useful. And ultimately, if you're investing in companies before earnings, I'm always concerned about that. Yeah, maybe you're right. Maybe you've said, people are too scared about this. They're going to be great. And maybe you're right, but maybe not. And believe me, it's much better to be reacting to actual numbers and actual data than predicted data or something like that. That's my personal view in any case. So what I find is that that earnings season period, which is about half of a quarter, sort of a circa 6-7 week period, that is the most kind of busy research focused time of a quarter. When you're in the other half of the quarter, the 6-7 months where they're 6-7 weeks, sorry, I'll say it correctly at some point, 6-7 weeks of a quarter when you've got fewer companies reporting. That's a time for more general research, perhaps things where you're looking at sort of longer term trends, keeping in touch with macro matters, looking at websites, perhaps some other opportunity to listen to a company speaking or related stuff happening. And again, I know it sounds a bit institutional and a bit boring, but believe me, you've got to be a little bit boring to be an investor. That's just the way it is. And believe me, it does help. It does improve your likely results and related. So again, that would be my suggestion. But ultimately, the key is really work hard, have fun. Remember, 90% inspiration, 10%, 90% perspiration, 10% inspiration and related. But ultimately, keep on working, keep on thinking, keep on trying to find new and different angles. Don't worry if you're wrong. Worry more if you're not keeping on trying to work harder, smarter, better to try to improve your future views on investments. And believe me, and I say this as somebody now with getting way too close to 30 years as a formal investor, I think to myself how silly I was even a few years ago, and how I become better and more thoughtful and related. And I hope that continues for a long, long time. But ultimately, that's how the investment game works, really. The key is to keep on pushing, keep on thinking, and keep on trying to work out all the angles, accepting you're wrong sometimes, but hopefully more often than not being right. And obviously then ultimately that leads you to become a good investor, a better investor, somebody who doesn't need other people to manage the money, but can manage it more themselves. Anyway, hopefully a few thoughts there in sort of the lengthy ramble about such related matters. So once again, we sort of come to an end of this podcast. Again, I kind of think I've sort of talked about lots and lots and perhaps told you not that much or too little. But the next podcast is going to be called, Do I Even Need to Ask If You Want to Be a Better Investor? I think you guess what I'm going to say for that, but we'll talk about that next time. Thanks so much for listening, and bye-bye.